Hi, everybody. Thank you and welcome. We'd like to, first of all, thank those who've already invested in Spartan Storage Fund 1. You are the foundation of the fund's success, and we're just very grateful for you investing in the fund, and this would all not be possible without you. My name is Ryan Gibson, and I'm going to walk through Spartan Storage Fund 1 tonight, what we purchased, our progress, and how we're going to close out the end of the year super strong. When we put together Spartan Storage Fund 1, we knew that it would have a lot of advantages over doing transactions on a deal-by-deal basis or individual syndications. But we realized that there was actually way more benefits to having the fund and the flexibility that allows specifically to include better financing. All the financing that we got in the portfolio has been at a fixed rate. It's been interest only, 25-year amortizing debt. And that is going to benefit our investors substantially during this time of uncertainty of interest rates in the economy. The other thing is we've had a more stringent buy box. We've had to very much challenge the acquisitions team at Spartan to only buy the facilities that perfectly fit into the return projections that we've made in the fund. And that eliminates the low performers, high performers. It puts everything in that good box where it's performing at or even above what we project. More efficient use of capital. Number 3, we've been able to deploy capital more efficiently across this 6-property portfolio that we've acquired, and that eliminates cash drag, and that makes it so we have better returns to investors. The 4th thing is we've acquired steeply discounted properties, and the fund's flexibility has allowed us the certainty to close those properties in all cash. Great example is we bought one of the assets in the fund, Free Up Storage Havelock, at a 40% market discount. And that would have not been possible given the close uncertainty of the lending environment, et cetera, without having the fund and being able to buy that asset in all cash. This avoided delays, and it enabled us to start distributions for the fund a full 2 months earlier. The other thing that we've liked this year is that we've had more expeditious closings. In years past, we put things under contract and timelines would slide because of financing constraints, et cetera. We've had more expeditious closings in the fund. And the 6th reason, streamlined investor reporting. We've been able to do monthly webinar updates, monthly financial reporting, monthly newsletters that break down each thing in the fund, and also as we approach the tax season, your K1s are going to be one K1 versus multiple K1s over the investments. And the other thing is risk mitigation and / economies of scale. We've recently named a new managing director of Free Up, and the fund's flexibility has allowed us to grow our staff so that we can have portfolio performance that is REIT-worthy. We're continuing to grow the Free Up operating brand, and that's allowed our fund to perform better as a result. But at the end of the day, our investors have benefited greatly from the fund, and this is especially important as we go through uncertain economic times. But we've learned a lot about launching the fund, and what I will say is the next one is going to be even better for our investors. And as we wrap up Fund 1 by the end of December, now is the best time to take advantage of Spartan Storage Fund 1 because of 100% bonus depreciation, cash flow, the fixed interest rate debt that we've secured, and the high-performing assets that are already in the fund. But what's next? In the new year, we can look forward to the launch of additional storage funds. Specifically, they're going to feature characteristics of both growth and income. In other words, cash flow-based funds that target much like Spartan Storage Fund 1, and a development-based fund that targets ground-up development of self-storage that takes on more growth potential, but also more risk. And what's great is, as being inaugural investors in Spartan, specifically inaugural investors in Spartan as in its totality or in Spartan Storage Fund 1, you're going to get preferential treatment in this new fund and anybody who you refer to the new funds in the new year. So without further ado, we're now going to go into a deep dive on an overview of Spartan Storage Fund 1. And I encourage you to send any questions that you have throughout the presentation to investors@spartan-investors.com. We'll address them at latest in 24 hours, but tonight we'll address a handful of questions at the end. And I'd like to get started first with just our disclaimers and getting those out of the way, which is we're not offering any tax, legal, or investment advice. Please do your own due diligence on the fund and consult your legal and tax team. And this is just a general overview. If you want to dive into all of our offering documents about the fund, you can go on our investor dashboard and obtain all that information there. So I'd like to introduce our executive leadership team here today at Spartan. This is Scott Lewis. He's our CEO, co-founder. My name is Ryan Gibson. I'm the Chief Investment Officer and co-founder of Spartan Investment Group. And last but not least, we have Ben Lapidus, who is our Chief Financial Officer and partner here at Spartan Investment Group. But if you have any questions about your fund, your investments, etc., we have an entire investor relations team here at Spartan, and you're in great hands under the leadership of Ed Osborne, our VP of Investments, Ted Green, our Managing Investor Manager, Lauren Breichel, and Roy Hansen. So a little bit about Spartan for those who've never tuned in. I apologize if you've already heard this before, but we have about 25,000 units under management, well over 100 employees now. We've been recognized by the Vet 100, and we have about 500 million in assets under management. And lastly, we've been recognized by Inc. 500, and we've raised over about 200 million in capital to date. But I think what I'm most proud of in the last year with Spartan is we've grown from the 90th largest self-storage operator in the United States to the 40th largest. And what this means to investors is that you're getting one of the top 50 operators to invest alongside. So you're getting all our systems, all our processes, all of our economies of scale. You get to plug into this efficiency that is only getting more robust and more creative and more advantageous for cash flow and upside. Inside Self Storage Magazine rates the top 100 operators in the United States every year, and we look forward to where we land next year in 2023. But this just kind of gives you an overview of where all of our assets are. We're primarily focused on the Sun Belt, so Florida, Georgia, Tennessee, Arkansas, etc. And we also have a smattering of assets in the strategic locations in Wisconsin and then the Pacific Northwest and in the Rockies. Why do we love self-storage? Why did we get into this business a handful of years ago? And that's because of how self-storage is performed. Specifically, this graph shows self-storage occupancy trend data versus how GDP has performed over the last 4 recessions. Starting in 1987, when the markets cratered over 30%, self-storage occupancy remained very strong. And the dot-com bust of 2000, when the markets again went down, GDP declined, self-storage occupancy did really, really well. And in the most recent Great Recession, when the markets went down quite a bit, quite astoundingly, self-storage remained steady. And then obviously during the COVID downturn in GDP, self-storage performed exceptionally well. And that's because this is a life business. People use self-storage not because they have too much stuff, but because they have life events. They move, they relocate, they downsize. During COVID, a lot of people turned their home office, converted into a home office. They had to get their stuff out, or they converted into a home gymnasium. Whatever it was, people moved, they downsized, they relocated. And that's why people use self-storage. And that's why we've been a big fan of the space, because of the risk mitigation. Specifically though, during COVID, rents increased 12.7% in that year. Very good performance. And we've even seen the REIT data out of Q2 of this year report double-digit same-store growth year over year. So very, very pleased with how it's performed. So getting to the fund, what have we purchased so far and what can you still participate in? So back in June, we closed on Plaza Mini Storage. This is just outside of New Bern, North Carolina. This is a facility that has over 1,500 units, about 191,000 square feet, and is very well occupied. It's consistently been between 90 to 95% occupied over the last 30 years. We'll dive into that in a bit. Then we went on in September to close 2 properties in the Louisville, Kentucky market, and that's the Horizon Storage transaction. This was Simpsonville and Shelbyville for $12.5 million. And then recently in October, we purchased 2 of the properties in the Go Store It portfolio, one in Louisville, Kentucky, one in Bonita Springs, Florida. And then lastly, Art Care Storage, which was a property that we bought in Chattanooga. So a really nice collection of assets, 6 in total. You can see where they are, starting from Florida over to New Bern and up in the Kentucky and Tennessee area. And in this market, you will talk about later, but we actually have 4 assets surrounding that property already. What we love about this, though, is every single one of these properties are in strong population growth markets. They're all benefiting from Spartan's economies of scale with other properties. And we really like the fact that we have below market rents on all of these properties, meaning that we come into these markets and they're 100% full and their rents are higher than ours. So our properties are full, and we're able to bring the rents and grow the rental income to just match what the market is doing on like-kind properties. So we see a very streamlined approach to increasing revenue. So we really like that they're below market rents. But kind of jumping in to where the assets are, the first one we're going to talk about, we're going to start Florida and go north. This one is in Bonita Springs, Florida, which is in the southwestern part of Florida. Florida is one of the fastest growing states. Specifically, the county that we're in Bonita Springs is Lee County, which is the second fastest growing county in the state of Florida. These are some stats about it. Again, second fastest county, growing county in Florida. So storage is mostly a driver of good population. There's over 29,000 cars that drive by this property every single day. Average household income is $141,000 per year. And what's important about medium household income within the 3 or 5 mile market on a storage facility is that usually our customers spend between 2.5% to 3.5% of their annual earnings on self-storage. So when you look at how much income is being generated around this property, we know that there's rental growth potential in the market and that our customers can afford a self-storage unit. So we really like that. And then the last thing that really checks the box on is 2.02% population growth year over year. This means that the market is not only good today, but it's continuing to grow and get better and better. So we really like this facility. The facility itself is beautiful. It's a Class A property, 3-story, climate controlled. It's mixed with some drive-up units as well. And we've locked in great fixed rate debt. So you don't even have to guess at what the interest rates are going to be. 5.48% fixed rate debt. So there's no variable, there's no cap needed on this debt. It's a Class A asset, great visibility. And back in October, we actually had 90 net new move-ins. So we bought this facility just after Hurricane Ian went through Southwest Florida and kind of up into the Northeast. And what we found is that self-storage is a service that people need after big disruption events. And after Hurricane Ian ripped through, we just saw rental activity just absolutely flourish at this property. So we're very pleased in how it's done so far to date. So moving up to North Carolina, over here in Havelock, which is on the eastern side, about 20 minutes from the Outer Banks, and it's in part of the New Bern MSA. What we love about this property is this is our cash cow in the portfolio. This property is 1,500 units. It's well occupied. The facility was mom and pop owned for over 30 years, and they just never did anything like raise rents or really push revenue or try to drive down cost. They just wanted it to be fully occupied. And this is typical of mom and pop owners, where they just want to have the properties full and not necessarily optimized for the best revenue. So we've already come in, we bought this property in June. We've already come in, we've increased the street rate 75% already. We've already repainted and rebranded, made this property part of the Free Up Storage portfolio. We renamed it Free Up Storage Havelock. And we purchased this with 100% cash to make sure we got the deal done. The rents were 51% below the market when we bought this facility. What I loved about this property is that within a 10-minute drive time, there was over 100,000 square feet of additional unmet demand, meaning even if somebody built another property in this market, we'd still have excess demand to play with in this market. Market's 99% occupied. This facility, when we took it over, was about 95% occupied. So really, really nice property. And you can see in our financials, the income growth on this facility has been excellent and is only going to get better. Moving on to Kentucky. Kentucky, home of bourbon, baseball, all the fun things we like to do as Americans. Kentucky Derby, grass. A lot of beef comes out of Kentucky due to the bluegrass state. And also, it's one of the largest manufacturer of automotive in the state of Kentucky. So really good population drivers. But what I love is we have 3 in the fund, all within the Louisville market. So we actually placed a really strong manager, district manager technically, in this region, which helps drive the takeover and the performance of these assets. And they have been exceptional so far to date. The properties themselves around the Louisville facility, we have 8 times the national population growth. So again, we love population growth. We love new residents moving to the area. This one has 22 new residential units being developed within a 5-mile radius. And the average household income, again, a really strong $110,000 per year. But what we like about the Simpsonville and Shelbyville assets is there's virtually no competition in those markets. Recently built property that has literally no other facilities, no other contenders within a 5-minute drive time. These facilities, the lender that gave us the fixed rate debt on these properties is very bullish about self-storage. German American Bank specifically held the mortgages on the Shelbyville and Simpsonville property, and they liked it so much that when we came in and bought it, they immediately wanted to give us a loan to lend on those facilities. They didn't want to see it go away. When we told them, hey, we're buying another one in Louisville, they immediately jumped on that. So we got great attractive financing, given the environment that we're in, 5.26% on the Shelbyville Simpsonville assets, and then 5.36% fixed rate debt, no rate cap needed. Really nice opportunity there. Limited competition, great population growth, and again, the economies of scale that we want, where we can hire a super high caliber manager to manage these assets, where we don't have to, skimp on a one-off deal in the middle of nowhere where it's going to be more difficult to find a high caliber manager. We can put a lot of resources into that manager. So that's really good. Tennessee, moving down that way. So we got Chattanooga here. And what we really like is the fund is only buying this one facility, which we renamed as the Free Up Storage Hickson. But what we like is that the fund is only buying one property, but guess what? We have multiple facilities in and around the Chattanooga market. Specifically, if you invested in the Southeast portfolio, Fort Oglethorpe is up there. And then we have the 2 Boy Scout Road, Middle Valley Road properties, which are part of the Boardwalk portfolio. And then actually that top left pin went away. We sold the Free Up Storage Centerville property. But you can see in the immediate market, we have a lot of economies of scale. This means, again, an outstanding district area manager, property manager. We have really good boots on the ground here. We're familiar with the market. And what I love is the Free Up Storage Hickson property has a lot of RV storage that was recently built, boat and RVs. High demand right now, right? Everybody's using boat and RVs. They're going out, doing more. Maybe they bought the RV and now they need to store it somewhere, etc. And this property is actually right down the road from Boy Scout Road, Free Up Storage Boy Scout Road, which we own. And we're about to put a shovel in the ground and expand that property. And that property, we're actually going to kick out all the boat and RV storage customers in that property. But guess where they're going to go? Hopefully, they're going to go right down the road to our newly built Free Up Storage Hickson property, which is going to immediately benefit. Again, great example of economies of scale in a market and benefiting from that. So really excited about that. This is a very familiar lender as well, 5.85% fixed rate debt and economies of scale. And again, high demand boat and RV storage. So really like how this fit nicely into the portfolio. And the lender really was eager to jump on this property, Simmons Bank, who's financed multiple facilities that we own. So kind of overall, these are the 6 assets in the fund. If you go onto the investor dashboard, I've updated the offering memorandum to speak specifically to these 6 assets. We've kind of refreshed the offering memorandum to give you kind of a deal by deal, what we're doing, what the business plan is. But these 6 assets are in the fund. And what we like, again, Bonita Springs, this is kind of our crown jewel of the portfolio, really nice climate controlled facility. And then we have Havelock, our cash cow, Kentucky properties that have limited competition, great population growth. And then we have the Chattanooga property, which gives us that great economy of scale. So really nice assets in the fund. Target returns, if you're wondering, 15 to 20% annualized returns. This includes the cash flow that you'll get on a monthly basis. That's going to be anywhere from 4 to 8% over the hold period. And then when you include all the profits you'll get from selling these assets, that equals about a 15 to 20% return, and we're targeting a 5-year hold period. So if you put in 50,000, you should expect to earn 50,000 and get your initial $50,000 back. So double your money in 5 years. 5 to 8% per annum cash flow. This is monthly distributions that get paid to you on the first of every single month. If you invested today, your funds would go active on the 15th of December, and then 3 months after that is when you would start getting your first distributions on a projected basis, right? It's just a projection. 13 to 18% levered IRR, and we expect, again, about a 1.7 to 2.2 times your money over the 5-year hold. This is kind of our cash flow projections. Year one, it's going to start off with that 4% range, maybe move up into the 5s. Year two, 5 to 7, kind of climbs up 6 to 8, 7 to 8%, et cetera. This is as we grow rents, as we get our arms around the properties, start to optimize expenses, and really start to take advantage of the markets that we're in with the under market rents. So far, we've had 4 distributions on the fund. One was at 5, and the remaining 3 were at 4%. So our average distributions cash flow on the fund have been 4.25%, and we expect that to continue. If you're wondering about depreciation, we expect that for every dollar invested, you're going to get about 30 cents of depreciation. So if you invest by the end of 2022, which we expect to close out the fund at the end of this month, you're going to get a K1 with depreciation of around 30%, approximately 30%. Could be more, could be less. We like to rough guess about 30%. We don't want to overpromise or under-deliver on this. And your K1s are sent out in March. So we guarantee delivery of K1s in the March tax timeframe. So that way, you're getting your K1s, you can file early, or you can decide to extend, whatever it might be. Talking about exit strategy, this is one of my favorite slides. We like to think of ourselves as this medium-sized fish. We're kind of like a portfolio storage aggregator. We go out, we find these mom and pops, we collect up a lot of properties, and we build out a portfolio. And what that does is it allows us, and we buy these from the mom and pops here, the smaller fish, the less sophisticated, maybe they're running their businesses a little bit different. We get them into our brand and our portfolio. And after a few months or even a year, we get our arms around the portfolio and start operating things a little bit more efficiently, grow our total collections on the facility, increase our NOI, increase our valuation, right? And what we've seen on recent sales of our investments is there's a lot of big fish out there, specifically like all of these big fish, right? We're the 40th largest operator, but there's 39 operators that are larger than us, that are more hungry, that have more of an appetite to continue growing their portfolios. But what they don't want to do is they don't want to mess around with the mom and pop. They want to deal with a portfolio aggregator like Spartan, so they can make big check writing plays on buying properties. But our exit strategy is not just about one singular course of action. That's foolish on any investment to be, oh, we're going to do this and do this, right? Having one exit strategy is really a success or a recipe for disaster, right? So we actually have found that while sometimes we may be that medium-sized fish, there's a lot of people that are trying to get into the self-storage industry. And so a lot of mom and pops are actually trying to buy facilities from us, either through a 1031 exchange or they're in multifamily. Now they're pivoting into storage. They're starting to do their first deal. So it really kind of goes to show that this asset class is kind of open to being attacked from both directions, right? Big investors group coming in and buying our facilities, or we can sell to smaller mom and pops. The other things that we've done is we've done recaps, meaning that we have actually gone out and refinanced the facility and returned 100% of the investor's cash, basically doing a BRRRR. And that allows kind of for infinite returns where you get all your money back tax-free on a refinance, and then you just start cash flowing into perpetuity. So, or until the asset sells. So really our goal is to get all of your cash back within 5 years and make a great return. That's the goal. And there's multiple different exit strategies that we can do. And investing in a high quality operator like Spartan provides those more opportunities with our portfolio composition today. So really excited about the different exit strategies. What do we do on these properties? This is one of our offices. This one is actually at one of our facilities just outside of Seattle. So we rebrand all of these assets. We come in, we put in, we repair the roofs, we do the drive aisles, we put in cameras. We well light the facility. We put in fencing. We do things that drive customer security, right? So when you show up to a property, you can see here we got cameras to the right, a nice branded logo, professional, self-storage manager, et cetera. And we make it easy to book and we make it easy to rent because of our facility feeling safe and secure. We enhance the signage at the property, do a little bit better job of marketing, and just overall kind of fix the place up. Now, revenue-wise or operational-wise, there's a lot of activities that we do as well, such as we rebrand every property into the brand that we own and started in our own property management company, Free Up Storage. We improve our staffing training to enhance the customer service experience. So usually we come in, and sometimes the managers last that used to run the properties, but most of the time they don't. That's definitely a practice that we're implementing now as we're retraining the staff and rehiring new staff. We do community partnerships, and we renovate the offices to have more of a good retail experience where we sell merchandise and other things that make a better accommodating experience. But the last thing that I like the most is we add ancillary revenues through tenant insurance sales. This means that 100% of our customers are required to buy tenant insurance. They don't have to buy ours, but if they do, we make it very convenient, and we revenue share on that tenant insurance. Specifically, we might charge between $13 and $20 a month per unit. And that drives additional revenue to the portfolio and to our investors. So really like how we can add ancillary revenue streams through things like tenant insurance, U-Haul truck rentals, merchandise, et cetera. So if you're wondering, how do I do my due diligence on the fund? How do I download all your documents, your prospectus, your track record? We even have something called an investment tracker tool that we put in here where if you want to log your distributions every month on an Excel spreadsheet that we built, that's all in here. But you can go to our Spartan-investors.com website and you can log in. And when you click on Spartan Storage Fund 1, you'll see a list of all these documents in the dashboard, and you can look at every single property. So if you want to see how we underwrote Free Up Storage Havelock as a standalone property, that is right in here in this document. If you want to see how we took all of the properties and rolled them up into the fund, there is a roll-up file that you can look at in this portfolio. If you want to see the PPM, the subscription agreement, the offering memorandum, whatever it might be, this is your data room where you can come in and download all these documents. We also do a feasibility study. So all of the aforementioned, housing developments and all these things that I talked about, it's all backed with data and sourced in our data room as well. So next steps. If you go to our website, Spartan-investors.com, you can see where you can log in here on the top. You can go in top right of our website. There's a little login for our investor dashboard. And you go in, you can also just contact us and say, hey, how do I move forward? I want to do this, or how can I get help to, sent a login for the investor dashboard, et cetera. You can go to email us at investors@Spartan-investors.com. But with that, I just wanted to thank everybody for coming. We're going to answer a few questions that are coming in, and I'm going to take the first one, which is, we got a lot of questions in the Q&A, so I'm going to answer as many as I can, but if you have any questions, you can just email us at investors@Spartan-investors.com. We'll get back with you within 24 hours, but I'm going to just run through a few questions that I have in the Q&A. Am I invested in one property or all of the properties if I invest now? So that's a great question. Thanks for asking that. You invest in all of the properties, and you are investing in the properties at their cost basis. So what we pay, there is no mark to market or revaluation of them. You get the benefits of all the sweat equity inside of the fund. So you own all 6 assets. You own the carried interest and the preferred return and all that on all 6 assets. Okay, next question. If I invest today, when will my funds go active? That's another really good question. If you invested today and your funds hit the account, your preferred return would start accruing on the 15th of December. That's when the next fund's activation date is. It's actually probably likely to be one of the last fund activation date. We might do one more on December 30th or something, but December 15th is likely the last fund's activation date. And then your distributions will begin 3 months thereafter. So March 1st or maybe even April 1st. math in public here. How long until my first distribution will start? I think we just answered that. And how soon will you stop taking investments into the fund? We are going to cut this off on December 31st, and that's mostly because of tax reasons, right? We want to make sure that everybody equally participates in the bonus depreciation, and then we'll have new funds in the next year. Is there a possibility you buy more properties? Really great question. So what I love is that Free Up Storage Havelock, we're actually refinancing that property, and the flexibility the fund provided was that we could actually take our time and find the most attractive rate and terms on that investment. So we locked up about a 5.95% interest rate, fixed rate debt, interest only, 25-year amortization, really great proceeds. And we can use those refinance proceeds to buy more cash flowing facilities. And right now is an excellent time to snipe off really good deals, because there's a lot of things coming to market potentially, and we could potentially get more discounts on future properties that the Fund 1 investors would benefit from. So because we have such a low leverage portfolio, currently we have the horsepower to go buy steeply discounted properties with this fund in the new year without raising any additional equity or diluting anybody. So we're really excited about that. So I think that's about all the time that we have for questions. So if you have any questions, email us at investors@spartan-investors.com. And I just wanted to again, thank everybody for watching the Fund 1 webinar. Thank you for taking the time to invest. We hope you have a great holiday season, and we look forward to answering your questions and working with you in the future. Thank you.